What's up, guys? It's your boy Quick Stocks. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of PayPal, ticker symbol PYPL, trading for $167 a share as of June 24th, 2020, equating to a market cap of $196 billion and a PE or price per earnings ratio of nearly 106. No one can argue that it's been a crazy ride for PayPal investors, as the company is nearly up 100% in the last 4 months and 382% since its IPO nearly 5 years ago. So what's the move? Are we maxing out on PayPal or loading up on silver coins in preparation for the apocalypse? This is your Quick Stock Analysis. For transparency's sake, we already have a small position in PayPal of $1,800, with $800 being that juicy profit. I feel like it's only right to start with this, as it's clearly been prevalent for the company. The global pandemic has wreaked havoc on a lot of companies. However, pump the brakes. A few select companies found it to be a massive catalyst for growth, and one of those companies just so happens to be PayPal. In the last few months, there has been an unprecedented demand for their products and services. When we look at PayPal's most recent earnings report, some of the stats they reported were absolutely bonkers. We see that transactions were up 20% year over year, with brand transactions up over 43%, more than double pre-COVID levels in January and February. They were averaging approximately 250,000 net new active accounts per day for the month of April, adding an all-time record of 7.5 million new accounts. And brace yourself, for Q2 2020, they are anticipating 15 to 20 million new net active accounts, which is great for the company, as not only do they make an absurd amount of money off transaction fees, but they also make interest off users' money. As when somebody deposits money on PayPal, it is automatically deposited into a corporate bank account, which earns interest. Let's take a quick look at PayPal's financials. As of March 21st, 2020, we see PayPal had over $10 billion in cash and short-term investments, with nearly $8 billion of that being cash, which certainly is a nice cushion, especially considering their short-term debt is abysmal. However, I should note the company's total liabilities are $38 billion, which of course is a lot. But considering that total liabilities consists of deferred income, leases, miscl, and so on, and considering that the company's primary focus is still growth, especially its newer companies, I'll chalk their balance sheet up to pretty good. And if I'm being honest, it's well deserved. When we look at the company's ecosystem that they've been building out for years via acquisitions and internal expansions, really did set them up for success. Let's quickly take a look at some of the companies in this ecosystem to see if we can get a better understanding of the company. We gotta start with PayPal's largest revenue source, which of course is PayPal's transaction revenue. PayPal has around 330 million active users, which represents an absolutely insane amount of money transferring through its service, with a merchant processing fee of a flat 2.9% plus 30 cents on domestic transactions in the US. And if you are a seller receiving funds that comes from countries outside the US, you'll be charged a much higher transaction cost of up to 4.4%, which, excuse the pun, but is making the company bank. Just for comparison, as we covered in our Visa video, a brick and mortar retail business can expect to see around a 2.3% transaction fee for Visa and MasterCard. Anyways, moving on. As if it's not enough, PayPal also owns Venmo. That's right, PayPal owns all of Venmo, which it acquired for $800 million in 2014. So in all honesty, Venmo and PayPal are fairly similar companies. Both charge similar fees and offer similar features. But that doesn't mean Venmo isn't a big player all on its own, with over 40 million active users, which has become absurdly popular for the younger generation. I should quickly note though, Venmo is not profitable yet, as it focuses on rapid growth. However, it is important to note that not only does Venmo make money with transaction fees, but they also invest float cash, which is cash consumers have sitting in their account, similar to PayPal. We also have Zoom, No, not the insanely popular video chat service, but PayPal Zoom with an X, which provides worldwide money transfers. It allows consumers to send money and pay bills in 52 countries. Of course, there's many more companies under PayPal's umbrella, but they offer similar features or allow users to use their current platforms. But for real, I can't overemphasize the marketplace that PayPal operates in. Global retail e-commerce is projected to grow to more than $6.5 trillion by 2023, up from $3.5 trillion in 2019. And PayPal has approximately a 20% share of this enormous market. And this share is very likely going to continue to grow in the coming years. Now that I've adequately hyped the company up, I think it is important for me to briefly talk about crypto, which alongside government regulation could be PayPal's biggest bear case. Just so that we are on the same page, crypto's goal is to eliminate third-party business models altogether, which goes directly against PayPal's intrinsic business model, where PayPal is just that, a third-party profit-oriented company. For example, if you consider Bitcoin, a user pays nearly no fees. And realistically, as crypto becomes more mainstream, it's only a matter of time for people to transaction to a system with little to no transaction fees. Does that mean that PayPal is going to become the landline of the next generation? Whereas, the landline is certainly useful, but only because you bought PayPal shares instead of paying your cell phone bill. Well, as a PayPal investor, I would certainly hope not. It is important to note, though, that PayPal has shown interest in integrating digital currencies on its platform. However, its current stance is more focused on blockchain, rather than cryptocurrency itself. However, let's be real, we are still a decade or two away before we see widespread adoption around the world. And one could certainly argue that an ever-growing company such as PayPal should be able to incorporate this ever-changing environment into its ecosystem. Regardless, it is something a long-term investor should put into consideration before starting an investment. There is no arguing that every day more transactions are being done digitally. However, it is anyone's guess where we're going to end up a few decades from now. So with all of this in mind, what's our move? Well, I'll be real, I have no doubt that we are headed to a cashless society. Considering that PayPal is on the forefront of this revolution, the company should see many more great years ahead of it. However, like I said, in our quick stock long-term portfolio, we already started a position in PayPal for the sub $90 range, which it would bite to nearly double our cost basis. However, from a long-term perspective, it is an absolutely amazing company. And honestly, I think the company is still a strong buy. Investors may want to enter with caution or dollar cost average considering the historic rally the company has had. Or at least wait until the end of June, as I wouldn't be surprised to see a 5% or more decrease in share price by the end of the month, as large pension funds will certainly be taking some profit out of PayPal as they rebalance their books after its historic rally. But that's a topic for another day. Anyways, guys, that's all I've got for today. As always, the best investment you can make is to go long on quick stocks. Hit that subscribe button now at 520 subscribers and plan an early retirement. I'll catch you guys in the next one.